Welcome to the Broken Pie Chart Podcast, episode number 47. I'm your host, Eric Moore, and today we're going to be talking about why do investors sometimes make really bad decisions, impulsive decisions? Why do they panic? And when you think about why investors panic, maybe why they make decisions that are poor, especially around times when the markets aren't performing very well, like 2008, 2009, we're going to take a look at a couple things, but it's interesting to think about. I went back and looked at some numbers that I'll share with you in a little bit about the flow of funds that I think you'll find interesting as far as how much money or percent of mutual funds were in money market type, which is essentially, cash that's earning a return, how much money was in bonds or flowed to bonds in, let's say, a year like 2009 after the market was at all-time lows. And regular listeners know that I'm a big advocate of for the majority of assets to either be buffered or hedged. And I'll link to a couple of different podcasts I did on buffered equity strategies. Of course, buffered strategies are where you want to get a market type return, but you want to have a buffer against the downside. And so maybe that's you don't want to feel the first 25% down on the downside, and that is appealing to a lot of people. When we talk about hedged equity strategies generally, you're long the market, you give up some of the upside, but then you want to have a floor in the portfolio, and maybe that's somewhere 8, 9, 10% down. And so, a lot of the things I'll talk about today deal with just how fear and panic and how that leads to bad decision making. And one of the things that having a buffered or especially a hedged equity strategy does, it takes some of the fear out of investing. And a lot of times people invest and they say, well, I'm a little bit worried about trying to time the market. I'm a little bit worried about, that I can suffer substantial loss. And we saw this back in 2008, 2009. And by the way, I'll get to kind of the main part of the podcast in a little bit. But it was interesting. Recently, somebody came over and talked to me and said, hey, the market's at all-time highs. And it's at all-time highs, and I'm a little bit worried. What's interesting, though, is, and we did a podcast, I'll link to this one, of course, several weeks ago, where Jay Persicelli came on, and Jay and I talked about how 36% of the time, based upon some research he did, the market is within 3% of an all-time high. And, when you think about that, if investors are saying, hey, the market's at all-time highs, maybe I should sell, that happens 36% of the time that it's within 3% of an all-time high or close to a high. And so if you kind of follow that logic, it means that, quite a bit people are saying, hey, the market's too high. Generally, the crowd, though, is wrong. And again, the benefit of having buffers or hedges is that, look, if your timing's not right or if the market does substantially sell off, you've got downside protection. If the market continues to run or moves higher, you're still invested. And we know that getting out of the market, you can potentially miss out on quite a bit of returns. And in general, individual investors, the do-it-yourself individual investors have not had as good of returns because their timing typically, and it's not anything bad, not really saying anything bad about individuals. It's just sometimes discipline and emotions and fear can get into the investing landscape and cause some poor decision making. But it is fascinating. We haven't had a recession since the end of the one in 2009. And recently, Jamie Dimon from Chase, somebody was asking him about a recession, and I'm paraphrasing. I don't have the exact quote, so I'm not quoting him word for word. But he said something to the effect of, at some point, conditions will come together that will cause a recession. When that is, who knows? It seems like, at some point we will. Now, will the recession be as bad as it was in 2008, 2009, or will be maybe a garden variety one, real short, real shallow, like we had? I think it was 91 we had one. Nobody talks about the Great Recession of 1991, but they do talk about the Great Recession of 2008, 2009. So at some point, that will happen. And that's why it's important to have downside protection or buffers in the portfolio. By the way, Australia actually hasn't had a recession since the mid-90s. I think they're one of, I don't want to jinx Australia to anyone from Australia who's listening. Not trying to jinx you, but they actually have not had an official recession since then. So we don't know when the next one is going to come. But right now, I would say that there are some people who say, well, the market's at all-time highs. Is it, aren't we due for recession? But it is interesting, and you see this in two ways. You would think that, hey, the market's at all-time highs, and people say, maybe their inclination is to not invest or to get out. And by the way, normally people's timing isn't great. But also, when the market's doing well, people tend to, when they do a self-evaluation on their risk, they tend to be okay with taking more risk because it's the recency bias. The market's been doing good for a couple of years. And so, although to be honest with you, the market's kind of been flat since mid to late 2018. But the market, generally has had a number of up years. So what's fascinating, though, is you kind of think about at the very lows of 2009 when capitulation happened and March of 2009, the S&P 500 was below $700 points. It was 666 point something and something, right? And today, it closed, or yesterday it closed right around 3,020 or somewhere right around there. So the market's come way back from off the bottoms. But what's interesting, though, is back then, when we think about how investors sometimes make rash decisions or panic or are more fearful and that fear paralyzes them with getting out of the market. Back then you would have thought, just for the same reason that people say, well, the market's getting around an all-time high. We haven't had a recession in a while. Again, I would say if you have buffers or hedges, that takes some of that fear and concern away. But it's interesting. Back then, I don't remember people saying, hey, the market's is 55% lower than it was. Maybe I ought to get in. The opposite happened back then. And just from experience, I talked to so many people that were literally in cash. And many of them didn't sell out when the market first started coming down. A lot of them sold out near the lows that I talked to and then were fearful and stayed in cash for quite some time and missed that sort of whole recovery. And so it's kind of interesting that you would think people would be flooding into stocks at those lows when the market was at such a discount from its recent point. But the first inclination was not to get in. And I'll share a couple numbers with you. There was a study by a Dalbar study. Hopefully I'm pronouncing that right. And they do a quantitative analysis of investor behavior. And in that study, I think it was the 2016 one. I kind of looked it up, and I'll post a link to that if I in the show notes. But they showed this stat, and it was quite fascinating. And it was a graph of the money market assets as a percentage of all mutual fund assets. So money markets are essentially, very short duration. Typically, they pay a little bit of interest, but it's not cash, but it's a lot of people refer to them as cash-like, just because of the makeup. And certainly, you shouldn't expect to earn very much in a money market fund. And so if you're parking your money in a money market fund for many, many years, you're simply going to trail not only inflation, but you're going to trail historical market returns. But at the very worst of the market, which was March of 2009, that was the absolute peak in the percentage of assets that were in money market funds. In fact, if you look, it was something around 43% of mutual fund assets, according to this study, was in money market funds. And that was the low. And so you think about that, what did that really mean? Well, that was the panic phase. And you had a lot of people getting out as the market was, near its lows. They're selling at the absolute worst time in hindsight, right? But they went to money market funds. And the other interesting thing, and again, I'll link to the piece I saw online, but if you look and you say, okay, well, when did the percentage of money market funds, and to give you an idea, kind of coming into 2007 or so, it was only about 22%. So it more than doubled. But it did not get down to that level until sometime close to 2012. And so what that tells me is a lot of people stayed in cash and they missed out on some of those first big legs in the recovery. And we know that missing out on some of the best days, months, or years of a market can seriously impact investment returns over the long run. So I found that really interesting. And the other thing that I found interesting is Morningstar had and this is, I don't know how many years ago this was, I think it was 2009, 2010 or so. And they had a little piece, and the question was, will new bond fund aficionados stick around? And I'll just read a little bit from the graph. And what they said was investors flooded bond funds with cash in 2009. And they said U.S. open-ended bond funds took in over $357 billion, and that was far more than any other asset class. And they also went on to say, for perspective, fixed income funds took in more flows in 2009 than they saw over the previous 5 calendar years combined. And so you look at this and you say, okay, well, 2008 bond funds, they took in less than $50 billion. 2009, over $350 billion. 2007 was probably $125 billion. 2006 was around, I don't know, I'm just eyeballing this, around $75 billion. 2005 was less than $50 billion. 2004 was, not much at all. So you look at this and you say, what does that tell you? Well, when equities were their cheapest, and then you think about this too, even if you used a classic, 60-40 portfolio and you went into, in 2009, you would think, well, bonds did better than stocks, so you should be selling bonds to buy stocks. That's not what happened. People not only went to money market funds, but they went to bond funds, and they stayed out of equities. And so it's just kind of this weird dichotomy where when we're at market highs, people are saying, well, maybe we should sell. But when we were at the very lows, people's actions told a different story. You would think that people would be saying, hey, I want to get into stocks because they're so cheap and they've sold off so much. Why don't I sell some bonds, which did better? But the opposite, based upon some research, happened. People went to money market funds, they went to bond funds in record numbers, when really, and by going to bond funds, they may have missed out on quite a bit of equity appreciation. So there's a couple things here, and we think about investor behavior, and one of the things that I try and do is help people not make poor decisions, and maybe avoiding a few poor decisions like capitulating and going to cash and staying in cash for a long time is one of those things. And by the way, investors tend to sell at the wrong times, especially those that try and time the market. But it's quite fascinating, this whole just the behavioral science that a lot of people are looking at now for how investors act. And this gets back to, one of the things that they feared back then was, as, I remember some people said, look, I stopped looking at my statements. I stopped opening the mail. I stopped even looking at it. I capitulated. I got out. I couldn't take it anymore. But that's really shows why sometimes what I'll call traditional asset allocation or just buying and holding doesn't really work. And one of the reasons why it doesn't work, it has no material downside protection. You hope that diversification will lessen losses, but as we've seen, in 2008, 2009, everything went down. And I've talked about that, why diversification fails in my book. I have a whole chapter on that. When you saw financials go down 80%, consumer cyclicals, I think were down, 40 or 50% from memory. Technology was down quite a bit. And then you look at the international markets, all of those were down quite a bit. So in 2008, 2009, even if you were in different sectors or markets or regions, everything kind of went down. And what that showed was diversification only works up to a point. The only thing that can can hedge the downside is something that will materially increase when the portfolio is, decreasing in value. And it's not a hope. It's, if you're using pieces or using, as I do, options that can actually hedge and have a defined floor, that's when you've actually got that protection in there. And that protection, though, by the way, does a couple things. And you think about what happened, what made somebody sell near the bottom in March of 2009, stay in cash for a few years, or get out of equities and go to bonds when equities had really done the poorest they've done since 1929 probably, right? So, and part of that is, sure, it's panic, it's fear, it's recency bias. And by the way, if investors were filling out maybe a questionnaire about their risk, back in 2008, 2009, they would self-select to be much less risky than they would be during a good bull market, when they, kind of forget it's recency bias and they kind of forget about the risk to the downside. So what I like to use with the buffers and hedged equity, I think it does a couple really important things. Number one is, if you can take the emotion out of the investing, that's really powerful. Because if you've got a defined floor in a portfolio and the market sells off materially, and your losses can be limited because you've got that defined protection outlined, you might even not worry too much. Certainly, you don't really have a reason to sell because at some point you've got that defined floor, but it takes the emotion out of it and staying invested. And that's really, really important. And so that's one of the major benefits that I see of using hedged and buffered equity strategies, is to avoid making those rash decisions, making those panic decisions, making those decisions when fear is at its greatest. And the other thing that the benefit to some of these strategies is, if you've got hedging profits or if you have avoided losses, well, your portfolio, if it didn't go down as much as, let's say, an unhedged portfolio, you then can take those hedging profits or avoided losses and then look to rebalance and buy more shares at depressed levels. And that's really counterintuitive. I shouldn't say counterintuitive. That's really counter to what some of the research I just shared with you showed. The research that I brought up earlier said that instead of rebalancing and having the opportunity to buy more, people sold equities and they went into cash or bond funds. And so part of that was, as markets decelerated or accelerated to the downside, they kind of made a panic move. And so part of the, obviously with doing investments and managing money and strategies, part of it is to try and strive for return, to manage risk, to look at, creating opportunities. But part of the other thing that I think is really important is to try and have people remove emotion. As Jay Pastorcelli would say, tell me a time when you made a really good decision when emotions were greatest, and probably you didn't make that great of a decision. So I will link to a couple different things. I'll link to that study, and I think you might find that interesting. The other thing I will tell you too is that I continue to hear more and more people talk about an impending recession. And I like what Jamie Dimon said. Jamie Dimon said at some point, we'll have one. Who knows when that is? We also don't know how bad it will be if and when it does come. But just intuitively, it's really fascinating. If a recession were to come next year, this would be the most forecasted recession that I remember. And I was telling somebody the other day that I was watching the local news, and they actually ran a story. They said the impending 2020 recession, and this is the local news that covers the farmers market and covers different things. And it's really fascinating. And this is the whole point of having a portfolio with buffers or hedges is, look, if it happens, it happens. You've got some downside protection. If it doesn't happen, great. You're going to capture, either all the upside, maybe a little bit more depending upon the strategy, or, majority of the upside. In the case of a hedged equity, give up some of the upside to have the floor in the portfolio. But what we do know is you can't really time the markets. And what we do know is if past actions, like in the 2008, 2009 are any indication, unfortunately, a lot of investors are going to make some rash decisions around fear. And looking back, the thing to do would be not to, even if you had a classic portfolio, would be to get out of bonds and go into equities and rebalance. But that's not what the data says. So I'll link to a couple things. As always, please share this with somebody who might find it valuable. I would encourage everyone to think about how they are set up for a potential downturn. Do you actually have real protection, material protection in the portfolio, or is it just a hope that things will work out? The other thing that I appreciate, the emails, go to razorwealth.com. You can go to the contact page and send me ideas for future podcast, and certainly love to hear from the listeners. All right, folks, we'll talk to you again next week. Have a good week.